Good morning. Yesterday's last discussion was on risk adjusted discount rate. If you have not marked yet, please make a note there. It is suitable for multiple choice question only. Yeah. Even the next method is suitable for MCQ, that is certainty equivalent coefficient method, CE method. Now this is again used when you are not certain about future cash flow. This topic is all about adjusting the risk when you are not sure of what is going to happen. Yeah. How do you estimate the future cash flow? See this. The certainty equivalent is a guaranteed return that the management would accept rather than accepting a higher but uncertain return. Underline this. Guaranteed return that management would accept rather than accepting higher but uncertain return. What is the meaning of this? Instead of saying that we are going to earn 10,000 rupee cash inflow at the end of year 1, if we are not sure, if we are only 80% sure, it is better to count only 8,000 as expected cash flow at the end of year 1. This is a high cash flow, but it is not a certain cash flow. I repeat the example. I think I'm going to earn 10,000. Now when I prepare my NPV table, year 0 is anyway without doubt a fixed number. Year 1, 2, 3, 4, 5 onwards, when I'm writing 10,000 and working out NPV, I know this 10,000 is not a certain number. It's an uncertain number. Therefore, what I do, I assign a certainty coefficient, certainty equivalent coefficient. Book says certainty equivalent coefficient, CEC. If I'm 100% sure I'm going to earn 10,000, then certainty equivalent coefficient will be 100%. 100% is nothing but 1, correct? But no one is sure about year 1, year 2, year 3. Yesterday also we have discussed what's going to happen next week can also be questioned. Definitely what will happen after 1 year will always be questioned. Therefore you are 80% sure. Then instead of taking 10,000 and working out your NPV, you consider only 8,000 and work out your NPV. Therefore what happens now in your NPV table, year 0 cash outflow, suppose if it is 2,80,000, this is without any doubt. This is multiplied by discounting factor. This will be your DCF. Year 0 anyway this is 1. Year 1 you are thinking of earning, or you're expecting that there is going to be 100 rupees of earning, but you're not sure. Therefore you multiply this with 0.8. 0.8 is the certainty equivalent coefficient. This will now come to 80. This you multiply by discounting factor and then you work out the NPV. By doing this, what happens? The NPV that I get here is the least possible NPV, or it's a conservative estimate of my NPV, because if this number is not 1, if this number is not 1, then understand you are not 100% sure of this. Therefore when you take here, you take the most conservative number. If you're not sure, then take 70%. If you're not sure of that, also take only 60%, correct? Imagine a hotel brand. I was just discussing with him the other day. Suppose I have a hotel brand, my logo, people know about my logo, my name, and I am planning to sell its franchisee rights to you. Now how will I estimate how much is going to be my year 1 income? In all franchisee arrangements, there is some fixed amount that you have to pay me. Second, there will be some percentage of sales that you'll have to share it with me. The fixed amount, I'm sure that you have to pay me, like minimum rent in royalty arrangement also, that will come. But plus it is 8% of sales, say for example. How do I estimate how much is that going to be? That depends on not my activity, that depends on your sales. Mine is only logo, mine is only the brand name. So I'm not sure whether your business is going to be successful or not. Therefore when I'm not sure of earning 100 rupee, better I assign a certainty equivalent coefficient. I think only 60% chance that I will earn 10,000. 10,000 here I'm writing it as 100. Instead of taking 100 and working out, if you take 100 and work out NPV, that will be an aggressive estimate of NPV. You are thinking 100 will happen. You are not sure. Therefore, better to take a conservative number. So 0.6, 0.5. What if this number is 0.1? That means you are least sure of earning this 100 rupee. It is more like a probability distribution. But in probability, you will have more than one probability at least. There is 80% chance of earning 10,000. There is 20% chance of earning 8,000 or 12,000. There are multiple probabilities. Here there is simply one number, certainty equivalent coefficient. Therefore, all your tables, as per book, they have actually expanded the table. It can be year, cash flow, DF and DCF. But in the study material, they have done it this way. Year, cash flow, you will then assign a certainty equivalent coefficient, and then you will multiply cash flow with certainty equivalent coefficient, and then you multiply with DF, and then you will get DCF. So basically, year 0, I am going to spend 10,000. What is the certainty that this will happen? 100%, which is 1 right now. Therefore, 10,000 into 1, 10,000. This is negative because outflow. Discounting factor for year 0 is always 1. Therefore, outflow will be 10,000. Year 1, I am expecting 3,000 to be my cash flow. But is it 100% certain? No. Then I assign a certainty equivalent coefficient, say 80%. This is purely an estimated figure. 80%, 90%, 20%, and so on. Then this will now become 2,400. This you multiply with discounting factor, and then you take the number here. Like this, year 2, year 3, year 4, and so on. And this number that you get is called NPV. Correct understanding of this is conservative NPV, because you're estimating at least this to be your NPV by the time you complete this project. And understand, how will I get these numbers? This is a pure estimated figure. In question they will give you, that's not the problem. But in real world, how do you assign the certainty? It is very, very subjective. If you ask this guy, if you ask him, if you ask her, answer will always be different. You will never get the same certainty equivalent coefficient. If you, sorry for this, if you ask an RCB fan about certainty equivalent coefficient, it's always 1, correct? I did not say the second part. I only said if you ask an RCB fan, then the CEC is always 1. Others may assign a different number, correct? And even the RCB fans, once the series begins, the CEC start moving here and there. 1 will finally become whatever number. I don't want to complete the sentence. I'm only saying it is very, very subjective. If you are a fan, how you see. If you are totally against it, how you see. If you are only a cricket fan and not a brand fan or a team fan, then how you see is very, very different. Last year how you saw, today how you are seeing, before commencement of tournament how you see, in the mid of the tournament how you see, is all going to be different. Therefore, this number, as of now, understand, in question they will provide, but in reality you will have to decide the certainty equivalent coefficient. It will be in the range of 0 to 1. 0 when you are sure it will never happen, 1 when you are sure it is going to happen, to the extent of 100%. Yeah, this can also be at max a multiple choice question. Just make a note, cannot be a 5 marks question. Question number 8. Investment 40 lakh rupee, discount rate 8%, calculate NPV under certainty equivalent coefficient method, CEC, using below cash flow. Year 1, 2, 3, 4 cash flows are given. Certainty equivalent coefficient 0.9 can be understood as 90% certainty. 0.85 is 85% certainty. That is the way to read this table. Yeah, just allow me to start and then you can complete this answer. So here is my table for NPV. Understand, here the NPV that we are calculating is the conservative estimate of NPV. Year 0, I have the number cash outflow. Year 1, 2, 3, 4, 5, 10 lakh, 18 lakh, 24 and 32. Certainty for year 0 is always 1. year 1 onwards, this may change. Numbers are given in the question. Multiply, you get cash flow into certainty equivalent coefficient, that is then multiplied with discounting factor. Discount rate is 8%, by the way, not 10%. Eight percent DF. Anyone has DCF column numbers? Last column, year 1. Anybody? Last column only. Minus 40. After that, 8.3. This is 3.2, is it? First 3.3. Hmm. Positive, I think. 15.43 or 4.2. Understand this is the conservative way of estimating NP. It can only be higher than this, not lower than this, because you've already undervalued your cash flows on annual basis. This is NPV. Mark a small star and understand this as conservative estimate of NPV. Conservative estimate of NPV. What if they give you two certainty equivalent coefficients for every year and then ask you to do conservative? Take the lower among the two. Because whenever you take a lower coefficient here, this number will come down. If this number comes down, this number will come down, and finally NPV will come down. If they say year 1 certainty equivalent coefficient can be 0.9 or 0.7, next year 0.6 or 0.4, and final question is estimate the least possible or make a conservative estimate of NPV, then you always have to take the lower one. Whenever it is conservative, you want to undervalue future cash inflows. You did this even in accounting standard for inventory. You take the lower of cost or NRV. Conservative is basically downgrading your assets. Cash inflow will result in asset creation, so we'll have to take the lower possible number. Yeah, both these methods are not going to be asked for 5 marks or 10 marks. The next method is what can come for 5 or 10. Mark this, important, practically very useful. sensitivity analysis, slightly big area. This can be 5 marks or more only. Can be 8 marks, can be 10 marks also. Yes, sensitivity analysis. Read. Sensitivity analysis, put in simple terms, is a modeling technique which is used in capital budgeting decision that is used to study, underline, impact of changes in variables on the outcome of a project. In a project, many variables like cost of capital, demand, selling price, cost per unit operate simultaneously. The change in these variables impact the outcome of the project. Definitely, if your demand comes down, sales quantity comes down, sales value comes down. If sales value comes down, your profit before depreciation and tax will come down, CFAT will come down, NPV will also come down. So one number changes in your NPV estimation, final NPV is going to get impacted. NPV is not a single number and that total, correct? I'll repeat. We started our chapter with one simple sum on capital budgeting. We started with PBDT, profit before depreciation and tax. Tell me, how do we reach PBDT first of all? To reach this, we would have done sales minus, say, variable cost minus fixed cost. Assume we have not taken depreciation. Then this is PBDT. Now tell me, how do you get this number, sales? This is based on sales quantity into selling price. Correct? That means this is 10,000 units into 7 rupee, 70,000 sales. Then variable cost 10,000 into, say, example 3 rupee, 30,000. From this you take out fixed cost, which is not based on number of units, it's a total number 10,000. This will now become 30,000 PBDT. From this minus D, then PBT minus tax, PAT, add back depreciation, CFAT, then your NPV table. Now tell me, you are estimating 10,000 to be the number of units sold. What if this comes down to 9,000? What will happen to NPV? Will the new NPV be less than old NPV or more than old NPV? Less, has to be less, because if sales come down, no doubt variable cost also will come down to some extent, but then PBDT will surely come down. Correct? Depreciation is a fixed number. Tax will come down. CFAT will surely come down. And if CFAT comes down, that will go to NPV table, year 1, 2, 3, 4, 5. If you take a lower cash inflow, your NPV will surely come down. Imagine old NPV with 10,000 units was positive 3,500 rupee. Old NPV or base NPV. Now if this 10,000 goes down by 10%, say sales quantity is now 9,000, your NPV, new NPV, will surely be less than 3,500. It may be 2,950. We don't know. When we work out, we will get to know. Which means one number changes in your estimation, it will surely impact your NPV. Same way, tell me, if your selling price comes down from 7 rupee to 5.5 rupee, will NPV come down? Yes. If variable cost from 3 goes up to 4, I'm taking only adverse variances. If 3 becomes 4, then also your NPV will fall. Fixed cost from 10,000 becomes 12,000, your NPV will fall. What if government changes the tax rate from 30%, they make it 45%, your NPV will fall. That means even if one item goes wrong in your estimation, NPV is going to get disturbed. And that's what they said. See, the change in these variables will impact the outcome of the project. More than one thing can also happen at the same time. What if selling price goes down and variable cost goes up? Together can also happen. It's not always one item at a time. And what we do in sensitivity analysis is we only change one item at a time and see how much will be the impact of that on our NPV. See this. It therefore becomes very difficult to assess change in underline which variable impacts the project outcome in a significant way. In sensitivity analysis, the project outcome is studied after taking into account the change in underline only one variable at a time. To understand this theory, we have to do one sum first. Classwork ACB 10, mark this question, important. I'll discuss this theory little later, this paragraph. ACB 9. Initial investment 10 lakh rupee. Project life is 1 year. Annual sales expected 2 lakh units. Selling price 40 rupee. Variable cost 15 rupee. Fixed cost 15 lakh rupee. Discount rate is 10%. Calculate NPV. Now to calculate NPV, I need cash flow. Year 0 is anyways given. Year 1 I'll have to estimate. Project life is only 1 year, therefore if I just multiply that with year 1 discounting factor, that is inflow versus outflow, I get the NPV. But that's not the main part of this question. Main part is here. Assuming 10% adverse variance, find out the most sensitive variable. First we need to work out base NPV. Base NPV is without considering this 10% adverse variance. Yep. Tell me first, don't copy this. How do I calculate base NPV, by the way? For base NPV, year 0, do we know cash outflow? Yes. Year 1, I need to calculate. To calculate, I have sales with me, number of units into selling price, minus variable cost, minus fixed cost. Correct? They have not given anything about tax or depreciation, so let's assume there is no tax or no depreciation. You can assume and take it as 30% also, nothing wrong. This will become my year 1 cash flow. There is only 1 year, project life is only for 1 year. This I multiply with discounting factor at 10% for 1 year. This number will be my inflow. The difference between these two will be my base NPV. This is without considering any 10% variance. Start this first. Heading computation of base NPV. Computation of base NPV. Year 0, cash outflow, ₹10 lakh. Year 1, sales is equal to 2 lakh into 40. Variable cost is 2 lakh units into 15. Correct? Variable cost is on unit basis. Fixed cost is on total basis. Fixed cost is also given 15 lakh rupee. Assuming no taxes, this itself is your cash flow at the end of year 1. Do we have cash flow number? 35 lakh. This should be multiplied by 0.909. 31,815 approximately. 21,81500 is my base NPV. Yes. Now the main part of the question. Assuming 10% adverse variance. See, they will never ask you favorable variance because you're adjusting risk. You want to know what can go wrong. Even in exam, if they say assuming 10% variance, you have to understand it as adverse variance. Adverse variance is everything going wrong. Sales quantity going down, selling price going down, variable cost going up, tax rate going up. All that is outflow to you, or all that is going to create loss to you. That is adverse variance. So they may not use the word adverse in exam. They may simply say assuming 10% variance. You are adjusting risk, uncertainty. That means you have to understand that variance as adverse variance. And then they're asking you find out the most sensitive variable. Now you have to start from the first item, which is sales quantity. You have to change this now by 10%. So 2 lakh going down is adverse. That means you have to rework out full NPV by taking 2 lakh minus 10% as your sales quantity, which is 1 lakh 80,000. Correct? Start now. Sales quantity decreasing by 10%. Year 0, there is no change. Year 1, sales will be 2 lakh minus 10%. It is 1 lakh 80,000 units. No change in price. Just listen for a minute. Do you remember in Inter, there was something called contribution in costing class? How do you calculate contribution? Selling price minus variable cost. Therefore, instead of showing sales separately and variable cost separately, you can directly start with contribution 1 lakh 80,000 into 40 minus 15 rupee. Nothing wrong if you do that. But then don't write it as sales. You directly start with contribution minus fixed cost right away. This minus, as of now I'm writing full. Variable cost is 15 rupee minus fixed cost 15 lakh. This number should be multiplied by 0.909. Do we have DCF? Sorry, 1727 approximately. You write your exact number. 17 is NPV or NPV is it? Then this is 27, correct? 1727 000. You have to now show percentage decrease in NPV. Understand this. Your original NPV was 2181,500. From there, it has now come down to 1727,000 divided by your base number or starting point. Correct? You were here. Understand it. 2181,500. You were here, but now you are here. So numerator will give you amount of decrease. Always divide by the starting point into 100. Anybody? 20.83%. That means if sales quantity decreases by 10%, your NPV will decrease by 20.83%. Like this, you have to take each item and find out the following. After sales quantity, now the second factor is selling price. Correct? Let me first list out all of you. Come to the base NPV. We're done with sales quantity. That means next working should be on selling price. After that, variable cost per unit, and then fixed cost. Then you have to change the discounting factor. As of now, we have taken 10%. I'll have to see what if it goes up, because discounting factor going up is bad. That will result in decrease in NPV. And last, some books do it, but it's not mandatory. They change even initial cash outflow. As of now, we have taken 10 lakh. What if that goes up by 10%? Why I'm saying this is not mandatory to do. This money is going right now. Therefore, this can't go wrong. You're estimating the cost of machine. You are in machine showroom. That machine showroom guy is saying, you pay 10 lakh, I will give you this machine. Now what is the chance 10 lakh will become 10% up? Correct? Therefore, initial investment, if you do not work out also, it's not wrong. What if they give tax rate? We would have taken 30% in the original answer. You will have to take 30% plus 10% adverse. Now don't make it 40%. It is 10% of 30. So you'll have to count it as 33% tax rate and then work out. Yeah. So start now. Second is selling price. Selling price decreases by 10%. Year 0, no change. Year 1, 2 lakh units into 40 will become 36. Variable cost per unit won't change. Correct? You are giving discount to your customer. That doesn't mean you will get discount from your supplier. Correct? So selling price going down is not equal to variable cost going down. This will be contribution now. From this, if you take out fixed cost of 15 lakh, that into 0.909. I've done 36 minus 15. This gives me contribution per unit into 2 lakh. Total contribution minus fixed cost. From that, I have minus fixed cost 15 lakh rupee. That into 0.909. You have year 1 number, anybody? 2450 or 300. Therefore, this is now 1454. 300. Percentage decrease when you do. Remember, you have to compare base with new. 33.3 approximately. Listen, if question is about only these two, sales quantity and sales price, what is the meaning now? 20.83% and 33.3%. Assume question ends here. Project is more sensitive to what now? Selling price than sales quantity. Okay, what is the use of knowing this? If sales quantity goes down, then businessman will not worry. But if selling price is going down, then he has to worry more, because a fall in price will hit you hard than fall in quantity. Then you can get a small board printed and say no discount, because you know selling price going down by 10% will result in NPV going down by 33.33%. That means if a customer is bargaining really hard, it is better to say, okay sir, I won't sell it to you. because sales quantity going down is okay to you. Selling price going down is not okay to you. Therefore, you need to know. That's why the name sensitivity analysis project is most sensitive to changes in selling price. Once you know this, your policy for the whole year is no change in selling price. Whichever festival it is, we are not going to do buy one get one free, 33% discount, 10% discount, no offers, because we know our project is very, very sensitive. If people don't come and buy, instead of 25 units, if we sell 21 units also, it's okay. But instead of selling at 100 rupee, if you have to sell it at 70 rupee, 80 rupee, then it is not okay. So management wants to know which is the most dangerous item in the project. We have done only two. There are many more. Finally, after doing all calculations, we'll have to write one line conclusion. As of now, out of the two, I'll go with selling price. Now, how they can convert this to MCQ? They'll give you four options. You'll have to work out all four and tick wherever you have the maximum impact. But that will be a well played game if they do that in MCQ pattern, because you'll have to do all this. You've done only two. Imagine third option is variable cost, fourth option is fixed cost. You'll have to then do all four. Wherever you see the maximum impact, the project is most sensitive to that particular item. Therefore, if it comes as MCQ, then these things you should know how to go fast. You don't have to write this so neatly. So third one now, which is the third factor, variable cost. Variable cost. You're talking about adverse variance, so it should go up. Cost going up is adverse. Price going down is adverse. Variable cost increases by 10%. Year 0, no change. Year 1, 2 lakh units. Selling price is 40 minus variable cost will now be 15 plus 10% up, 16.5. This is your new contribution from this minus the fixed cost. This into discounting factor for year 1. 21, 89, 88, positive 1908, 800. Yes, percentage decrease in NPV. Now, what is the meaning of variable cost going up? If your supplier starts increasing the price, then it's not a big problem to you, correct? Raw material cost goes up by 10%. You know your NPV will fall by 12.5% only. But if you start giving discount to your customers, then it will fall by 33.33%. That means you're not much worried when there is inflation in your cost. You are worried, it is falling, but not as much as giving discount. Yes, you try now. The next one is increase in fixed cost by 10%. Most of the things are same. Fixed cost in place of 15 lakh, we need to take it as 16.5 lakh. So I will straight away take original NPV and do minus 1.5 lakh. Correct? Understand, if it is MCQ, whatever is the original number, you minus only extra fixed cost. Original NPV you have with you, not the NPV, this number, this 35 lakh. Now this 35 lakh will come down by 1.5 lakh because fixed cost is going up by 1.5 lakh. So I'll directly do 33.5 lakh into 0.909 minus 10 lakh rupees. If anyone has this NPV. 2045, correct? 150. $6.2 approximately. What is the practical application of this? If your rent, which is a fixed cost, is going up by 10%, then your NPV will not get affected much. Or if you're planning to shift from your present showroom to another showroom, a better location, rent is 10% high there, then you know not a big problem. It will only create 6% fall in NPV. But even after that, you're not getting into negative NPV. So it's not a loss, but there is a fall in NPV, which is the next item we have. Discount rate, increase in discount rate by 10%. That means now your DF will be 11%. It is 10% of 10, 1% increase. So year 0, no change. Year 1, up to this number, 35 lakh, correct? No need of any calculation. But this will be 1 divided by 1.11. You need 11% DF. If you have it, then this 3153, 500, this 2153, 500. What's the percentage fall? 1.28. This answer actually we can present in a table, but then you won't be able to complete all this in a single table. Say particulars, base NPV, sales quantity falls by 10%, selling price falls by 10%, variable cost, fixed cost, discounting factor. In one sheet you won't be able to fill. You'll again end up doing two tables. Particulars again, then 4 here and 4 here. That way is also okay, or if you're comfortable this way, totally fine. Now tell me, if tax rate is given, then from 35 lakh you minus that, and then you will add back depreciation. If that is also given, they can drag this question by giving total fixed cost 15 lakh, in that 1 lakh is depreciation. Then first you do minus 15 lakh and depreciation, add back only that depreciation, then you get CF80, and then you work out. Tax rate going up is adverse. If it is 30% original, you have to count it as 30 plus 10% of 30, 33%. Now tell me, out of all, where do you have the maximum impact? Selling price. So one line conclusion. Considering maximum decrease in NPV, comma, project is most sensitive to selling price. Yes. Do you think this conclusion is true for DMart also? Definitely no. Never. Because they're always running with offers. That means selling price is not important to them. Then what else do you think is the sensitive factor to them? Volume, quantity. They are okay with buy one get one free also, but they want those 2 units to go. For them, the target is to have more units because it's a pure volume based business. They may get just 1 rupee margin by selling an item of 38 rupee. So they're not worried about 38 coming down to 37.5 also. It will come down to 0.5 rupee margin. But then they know if 38 becomes 37.5, 100 units will become 150 units. For them, the sensitive variable is volume. So understand, whoever is giving unbelievable discounts all the time throughout the year, then for them price is not as important as volume. If volume goes down, then DMart has problem. If price is going down, definitely they don't have problem. Yeah. If you have visited DMart any day, you will understand what I'm saying. Volume is their strength, and if that goes down, then it's a big problem to them. Sometimes you recheck whether the number is correct or not. That's the kind of discount they give. MRP 36, they say no, 17 rupee. You question yourself whether I'm reading properly or not. But they're okay. They are doing. And you go any day. This I can challenge this. I myself tried experimenting. After festival, normally these shops are less crowded, is what I was thinking. I went one day after Diwali on a weekday afternoon. Remember that was Wednesday afternoon 2:30 after Diwali festival. Even then there was enough rush. Normally during festival before that 1 week, 3 days before that, people will buy a lot. So that is enough for their house for another 1 week. But no, even after Diwali there was enough crowd. That means people go there only because of price. Now their strength is reducing the price and increasing the volume. In their project, this answer will never come. If this answer comes, then they should start selling everything at MRP from tomorrow. Then nobody will go to DMart. Why will I go? Anyway, they are not the manufacturer of that item which I'm buying. It is the same rinse soap, same Head and Shoulders. Whether I go here or to another shop, they are not the maker. I'm going only because of price. That means for them, price is not the primary consideration. They want volume. They want more units. Therefore, one learning from this, you go to any shop, if the board is already 40% discount, then understand price is not the headache for them. You can bargain 50% also. There is a chance you will get. Because who can give 40% can give 50 also. If price was so important to them, they would never come with 40% discount offer also. Next time when you go to, normally you see this in cloth shops, 40% discount, buy one get one free. If you see 40%, you can surely ask for 45 or 50. There is a chance you may get also. Try. What is the loss? If he says yes, you save 10%. If no, anyway you are ready to pay 60% price. If that person is not ready to give you discount, why is he starting with 40 first of all? He should say fixed price board. Correct? He is giving 40. You can surely ask 45. You can surely ask 50 also, because for them selling that shirt is important. Even slightly at a lower price, that's not their problem, because they'll still have margin. Even after 40% discount, no one is in loss. That means they still have enough space between cost and the price. You can always bargain for higher discount in those places where they're already giving you big discount. 5% discount, if you ask 10, they may not give, but someone giving 40 can easily give 45 also. Yes. There is one more way of doing sensitivity analysis. My question, what if this 10% adverse variance is not printed? Then what to do in exam? One way you can assume any number. Anyway, you're taking same 10% for all factors. So that is still a fair way of calculating. There is one more way of doing sensitivity analysis that is there in the next question. Next question will have to work out under both the normal style of sensitivity, and after that I have given classwork 10.1, and that is same question number 10 under an alternative approach. Yeah, read. From the following details related to a project, analyze the sensitivity of the project to changes in underline initial project cost, annual cash inflow, discounting factor, or cost of capital, which means they have already given what to do. It is not like the previous sum. You only have to do sensitivity check for these three: initial cost, annual cash inflow, and discounting factor. Initial project cost given, cash inflow given, project life 4 years, last sum was only 1 year, and then discounting factor is 10%. Examine which of three factors the project is most sensitive to. Now observe this number 45,000 is annual cash inflow and the project life is 4 years. Is it a case of annuity now? I discussed this yesterday. Annuity is when you earn same cash inflow every year. That means I'll have to do summation of discounting factors for 4 years. Yeah. Any sensitivity analysis, first you need the base NPV, and then you can consider an adverse variance and then identify which is the most dangerous item. Start now. First, computation of base NPV. Year 0 cash flow cash outflow 1,20,000. 4 years project, and my annual cash flows are same, so I can write it as year 1 to 4. This is cash inflow 45,000. Since the annual number is constant, I will write what now? PVAF, correct? Discounting factor or PVIF is for specific individual years. When you do summation, it is PVAF at 10% for 4 years. 1 divided by 1 plus rate. Year 1, 2, 3, 4. That summation should be 2 point something. 3.168 or 169. Multiply this with 45,000. Sorry. 605. Therefore, NPV is positive 22605. Correct. Now, they haven't given adverse variance percentage, so we'll have to make an assumption. That means this answer is still like the previous answer. I'm yet to discuss the alternate way. Assuming 10% adverse variance, you can count any number, 20% also, which is the first item as per the question. Initial project cost. NPV is equal to, I don't have to work out full table. Tell me that minus 1,20,000, only that will change, correct? That will go up by 10%. So NPV year 0 will be minus, correct, 132,000. Year 1 to 4, you can simply write same as above. There is no change in this. Is it positive 10,605? Yeah, therefore percentage decrease in NPV 50%, 53%. Remember, original number 22605 minus new number by starting point. Second, in the question, they mentioned annual cash inflow to be changed now. Correct? So this will be same year 0, 1,20,000. Year 1 to 4. Original number was 45,000, but now it is 40,500. 45,000 minus 10% decrease. This multiplied by 3.169. You have this? No, you don't have to do it every year because 45,000 is same. If this was different, then you had to do table every time. Anybody this number? 370? That's okay. I'm taking 340. 8340. Positive. 1 second, I have a small doubt here. Can this number be negative? Not in this particular case. Is there a chance this can be negative? Imagine if this is negative 8334. Then when you work out decrease, you have to count 22,605 plus 8,340. Then decrease will be more than 100%, because from positive to 0, from there it has gone down to negative. So in exam, if you get a negative number here, it's not wrong. There is a chance. Original was positive doesn't mean all has to be positive. Don't worry. Just continue the calculation. Percentage decrease in PV. Original number minus new number divided by original number. 63% approximately. As per the question, one more factor is cost of capital or discount rate. Year 0, no change. Year 1 to 4, 45,000 will be multiplied by PVAF at original was 10%. We have to now take 11%. 4 years. 102 into this 1 is it? 590. So done. Now tell me which is the final answer. Biggest fall was 63.08 annual cash inflow. Write down. One line. Conclusion. Write the conclusion. Considering maximum decrease. Considering maximum decrease in NPV, project is said to be project is said to be most sensitive to decrease in annual cash inflow. If I take 20% and try, my conclusion will still remain same. Answers may change, correct? Percentages will change. But then since I am going to apply same 20% for all three calculations, final effect is same, correct? Now in textbook, you have alternate way of doing sensitivity analysis. Refer class notes in your notebook, write down the heading. Alternate way of sensitivity analysis. Alternate way of sensitivity analysis. Listen to me. The other way is finding out under what circumstance will my NPV becomes zero. That is, as of now, what we did, annual cash inflow goes down by 10%. What is the impact on NPV? It will go down, but by what percentage? What is the alternate way? If my NPV has to reach zero, what should be the fall in annual cash inflow? I repeat, it's exactly reverse way of doing. What we did is, if annual cash inflow goes down by 10%, how much is the impact on my NPV? Now the second way is, if this NPV has to reach zero, how much should be my annual cash inflow? Now that unknown number will have to work with reverse methodology. We'll have to keep that as X. Now in this case, how much was annual cash inflow? 45,000. Now if that 45,000 becomes 37,000, 36,000 or 41,000, if my NPV is going to become zero, then from 45,000 minus 37,000, then I calculate the percentage. I'll just take an example. As of now, year 0, 1,20,000. Year 1 to 4, it is 45,000. Let us keep that as X into, how much is the discounting factor summation? 3.169. So this will now become 3.169x, and you want this to be 0, correct? Now the equation is negative 1,20,000 positive 3.169x should be equal to 0. Now you can shift x that side and then calculate the value of x. Suppose value of x comes to 37,000. I'm just taking an example. Tell me the meaning of this 37,000. From present 45,000, if this goes down to 37,000, my NPV will reach 0. Then what I do? I find out the percentage decrease here. As of now 45,000, if it becomes 37,000, from as of now 45,000 into 100, I'm just taking some number, say 60%. Answer now. What is the meaning of 60%? If annual cash inflow falls by 60%, my NPV will fall by 100%. Why am I saying 100%? Because I'm hitting 0. Wherever you are, you'll come to 0. That means it's a fall of 100%. This is the alternate way. To do the sum in this way, you don't need the 10% adverse variance information because you are doing the reverse working. Correct? Start now in a notebook. We can start writing. We can estimate under what circumstance. We can estimate under what circumstance the NPV of the project becomes zero. NPV of the project becomes zero. In bracket, decrease in NPV by 100%. Full stop. Next line, we need to do reverse working. Write down, we need to do reverse working to solve the sum under this method. To solve the sum under this method. Now let's try the same question number 10 under this. I've given that as separate question 10.1. Consider classwork ACB 10 and work out sensitivity under alternate way. Start now. Solution 2. CB 10.1. First you write the base NPV. In exam you'll have to calculate. Here you can write same as above. Base is not changing anyway. 22 64 605. Yes. Which was the first item? Project cost. Start now. Project cost. Let it be X. Correct. NPV is equal to 0. This is your target. For NPV to be equal to 0, your cash inflow should be equal to cash outflow. Cash inflow equal to cash outflow. Inflow, there is no change. As of now, I'm only working out for project cost. 45,000 into 3.169. Correct. This should be equal to cash outflow. Since I've written 0 here, I can write it as minus X. Inflow minus outflow. Correct. Cash outflow I do not know. I've written 0 this side. That's why I wrote it as minus X. Tell me how to proceed now. This is the simplest way actually. Just have to shift one number here, the other number will become minus X. How much is 45,000 into 3.169? 40,000. 42,605 minus X. Therefore, X will become 142,605. How much is X as of now? 1,20,000. So percentage change, not NPV now. This percentage change in initial project cost is equal to, it should be 142,605. Then my NPV will be 0. But as of now, it is 1,20,000 divided by 1,20,000. Remember, your base data is 120, not 142. 18.84%. For your reference, if you want to write down a class note, I leave it to you. If you want, only you write. What is the meaning of 18.84? If project cost goes up by 18.84%, NPV will fall by 100%. Correct? Listen now, one small question from my side. This way, you will next work out for cash inflow. Correct? Suppose that comes to 28%. And then you'll work out discounting factor. That comes to 8%. Now, what's our final answer? 18.8, 28 or 8%? Highest or lowest? I have to take lowest, because even just 8% change will bring down NPV to 0, whereas project cost has to change by 18% for the NPV to be equal to 0. That means a very small change, as 8.1% change in discounting factor will bring down your NPV to negative, because at 8% it is 0, 8.1 will become negative. But if it is 8.1 in initial project outflow or cash inflow, it won't impact much, because for NPV to reach 0, this should change by 18.8%. Imagine some other number is 68%. You are safest here. Correct? 68% change only will create a problem. Up to that, you are safe. That means now you will go by the lowest item. Imagine variable cost is also there. Here they directly gave annual cash inflow, and sensitivity when you worked out, you got 2%. Very, very dangerous. If there is 2.1% increase in your variable cost, that's enough. Your NPV will start in negative zone. At 2%, it is 0. Correct? Here a very small change will bring down NPV down to 0. Therefore, you will go by the lowest number, not the highest number. It's reverse working, correct? Everything has to be reverse. So what is the next thing now? Which is the next item to be changed? Cash inflow. Annual cash inflow. Let it be X. Now tell me, for NPV to be 0, cash outflow should be equal to cash inflow. Outflow is 1,20,000. This should be equal to inflow, which I am writing as X. Correct? But this is not 1 year income. This will come 4 times 3.169. 1,20,000 should be equal to 3.169x. Just have to shift it this way. Anyone? 37,867 rupee should be your annual cash inflow. Then your NPV will reach 0. Therefore, percentage decrease. Original number 45,000, and you want this to be 37,867 by original number 15 point. Now just consider the two answers you have. If project cost changes by 18%, 18.8, then NPV will be 0. But cash inflow, even if it changes by 15.85, then it will be 0. That means project is most sensitive to cash inflow. By the way, conclusion is same. whether you do 10% adverse variance or reverse working, final conclusion will be same. Two different ways. I'm not saying two different solutions, different ways of doing same sensitivity analysis. Which is the last one now? Cost of capital or discount rate. Now there is one term for this. You want to find out the discount rate at which NPV is going to be zero. This is called what now? IRR. This is why I discussed that IRR in first session. The rate at which my NPV reaches zero. Right? Again, cash outflow would be equal to cash inflow. But what I don't know now is discount rate. Outflow 1,20,000. This is 45,000. Now this summation will be X. This is summation for 4 years. Correct? This will be 1,20,000 divided by 45,000. This should be this answer you won't get easily. Correct? How much is this? 2.67 should be equal to X. So you can't answer now. 2.67 is what? Summation of discounting factor for 4 years. That means now you have to do trial error in such a manner that you reach 2.67 as a summation of discounting factors. There are shortcuts, but I'm working out in a detailed manner. See, shortcut in MCQ, if you don't know how to do, substitute all 4 options. But I don't want to teach that way, then you'll never know how to do it in a descriptive format. Easy, no, you substitute all. That's how we did in foundation also. Some of the students know this very well. But that's not the way to learn. Now tell me, originally we did the sum with 10%. At 10%, my summation was 3.169. I want that to come down to 2.67. That means my trial should be higher than 10%. I may take 20, I may take 30, but my target is to reach 2.67. Therefore, start writing. At 10%, PVAF for 4 years is 3.169. But you want to reach 2.67. Therefore, 20%. In Calci, can you try? 1 divided by 1.2, 4 years, 2.59. I'm happy I got 2.59 because it is below 2.67. I wanted 2.67. Now I have one number below that, one number above that. Remember how we did IRR? There we wanted NPV 0, one positive, one negative. Now I want summation of discounting factor to be 2.67. One number is above and one number is below. Between this, I can now do cross multiplication. Therefore, nothing wrong if you write IRR here. Correct? Because ultimately you want NPV to be 0. So IRR is equal to, tell me how to do. It is more than 10. That is for sure. How do I know it is more than 10? At 10, I was getting positive NPV. Original answer. I want 0 NPV. Remember now, if 10 becomes 20, that means there is increase by 10 points. My summation of discounting factor from 3.169, it will go down to 2.59. But from 3.169, I wanted to go to 2.67. Correct? Same way. There in IRR, I wanted 0 NPV. One positive, one negative. I found out total fall in NPV. But now I want to reach 2.67. At 10%, I was at 3.169. Now understand, if you put a timeline, it won't be 0 now. What is your target? You want to reach 2.67. Correct? When it was 10%, you were here 3.169. You tried 20%, you went to 2.59. That means from here to here, but you wanted to go from here to here. If you want this, you can just write as class note. at 20%. Those who want, copy this as class note, not to be written in exam. When you are at 10%, you are here 3.169 summation. When you tried 20, you went down to 2.59. So you went down by this distance. See what I'm highlighting, 3.169 minus 2.59. You wanted this 3.169 to fall, but only till 2.67, correct? Therefore, what is the cross multiplication now? When I increase it by 10 pointers, correct? This 10 became 20. 3.169 came down to 2.59. What's the fall? 0.579. But the fall that you wanted was 3.169 to 2.67. How much is that? 0.499. I'm writing here. IRR is what? 10 plus 8.61. That means 18.61%. This is not the final answer. If discounting rate becomes 18.61, your NPV reaches 0. Same way you have to show percentage change, correct? Done till here. Percentage change in discount rate. Discount rate is also called as cost of capital, one and the same. You want it to be 18.61, correct? But as of now it is 10. By 10 into 100. This will be a very big number, I think. 86.1%. What is the meaning? If your discount rate goes up by 86%, then only your NPV will become 0. If you remember in first class, when we discussed IRR, I said higher the IRR, safer the project. Here is a good example. Discount rate going up by 86%, only then it's a problem to you. If 10% becomes 14%, which is 4 points increase, which is 40% increase, considering 10 as the starting point, you are not worried. You are worried only if your discount rate goes up by 86%. Understand, 86% on 10, which is 8.6. So if it becomes 18.6, then only it's a problem to you. Now tell me 3 answers that you have here. This changing by 18.84 will bring down NPV to 0. But if this changes by just 15% also, NPV 0. But this has to change 86% for NPV to be 0. That means a very small change in price or cash inflow is enough to bring your NPV to 0. That was the same conclusion under old method also. Yeah, start now. Considering a very small change in annual cash inflow, correct, comma, project is considered to be most sensitive to the same. Project is considered to be most sensitive to the same. Now in exam, which they won't mention alternate way, original way. which way to follow. If the 10% 20% adverse variance is given, then go by the original approach. If that adverse variance is not given, instead of making an assumption, go by this. Yeah. Just write a class note or maybe on top of the notebook. In exam, in exam, if adverse variance percentage is given, adverse variance percentage is given, then work out under first method. Full stop. Otherwise, work out under alternate method. Now I know the doubt. What if even the adverse variance percentage is not given? Then also I can assume and do. Correct? I can assume 10%, 20% and work out the sum. Why is that wrong? It is not wrong, but the problem is every student can take his or her own rate. Final conclusion will still be same because they apply same. So what if someone takes 27% change? You can't say he is wrong. Somebody takes 10, somebody takes 20. For validator, they'll have to have that many answers. Final conclusion will be same. They need to have that many answers. Logically, they should give marks for either way, the reverse working way or making an assumption. But what if the suggested answer has the alternate way only because question does not specify percentage adverse variance? In the exam hall, he may take 10, he may take 5, she may take 20%. All of them will have different final answers. Though conclusion is same, answers numbers are different. Unnecessary, we are giving an option to take out marks. So when question doesn't specify, better you do reverse working, the alternate way only. Then all our answers should be same. Anyway, we are all starting with X only. That answer can't change. Conclusion also won't change. Yes. 5 minutes break. Then we'll continue. Yes. Next discussion is scenario analysis. Before we go there, in sensitivity analysis, you tried changing one item at a time. That means what's the assumption? Only one thing can go wrong at a time. What if two, three things go wrong at the same time? Say selling price comes down and variable cost goes up, fixed cost goes up, everything happens together. Possible? It cannot be that only one thing can go wrong. More than one thing can also go wrong. This is what I have noticed in reality also. If things start going in wrong direction, not one, everything will go in wrong direction. Therefore, it's not that only one thing will be a problem. What if more than one thing changes? That we study in scenario analysis. Sensitivity is about one item at a time. Scenario analysis is multiple items at a time. Now tell me, sales quantity goes down, selling price goes down, variable cost goes up, fixed cost also goes up. Everything happens in same year. Now you can't use sensitivity analysis. For sensitivity, only one thing should change. Now all four things are going against you. Now that becomes a worst case scenario because everything is going in wrong direction, opposite direction. Then what is best case scenario? Quantity goes up, price is also going up, variable cost is going down, fixed cost is also going down. Imagine tax rate also goes down. Everything happens in the same year. Then that's the best case scenario, right? And then there can be moderate scenario where quantity goes up but price comes down, variable cost goes up but fixed cost comes down. Combination of one or two good things, one or two bad things. Now this is the most likely scenario. So scenario analysis is changing more than one variable at a time. But before we understand scenario analysis, there is something from statistics that we should learn first. Concept of correlation. Do you remember the topic name? Yeah, the one that many did not like, especially the regression part. Anyway, you don't have regression here, but at least you have correlation. Anyone can answer what is the range of correlation from 2, positive 1 to negative 1, plus 1 to minus 1, or 0 to 1, minus 1 to plus 1. There were, I think, at foundation level or 11th and 12th, you have studied 3 correlations. Perfectly positive correlation. Remember? Do one thing. Come to page 198. Now that space is for this purpose only. And you will use correlation in many topics. Better we'll discuss quickly. Okay, I'll go one step behind. At least direct relationship, inverse relationship, we know. Yeah. Those who are following stock market, yesterday Nifty fell down by a big number. Okay. And if you are also following gold market, gold ETF is something that you can start watching from today. Yeah. Those who want to learn correlation, Add these two, bookmark. One Nifty, second gold ETF, not gold price, not hard gold price, gold ETF, exchange traded fund. We will learn what is ETF in another topic. There is always an inverse relationship between these two. Inverse relationship is nothing but correlation being -1. I'll explain, I'll dictate, not to worry. Just try and understand. If one number goes up, if the other number is also going up in same direction, then they're said to be positively correlated. If one goes down, other is also going down. That means it is direct relationship. In simple words, in statistics, we call it as positive correlation. What is negative correlation? One goes up, the other always goes down. This is Nifty and gold ETF example. How many of you can recall during lockdown, March 2020, Nifty fell down drastically. And same month, March, April, May of that year, if you check, gold prices was at all-time high. I'll send a small screenshot of both the charts today after the class. Gold ETF went up as and when Nifty went down. And during lockdown, Nifty kept going down day after day after day. And gold prices, physical gold also, and gold ETF, because I'm taking Nifty from stock market. Another thing about gold in stock market only I should take, not physical with this. Therefore, I'm taking gold ETF. Basically, gold ETF is a derivative instrument. If gold price goes up, ETF goes up. I want to invest in gold, but I don't like physical gold. Then what is the way? This is the way. Gold exchange traded funds. One more place where you can start investing on monthly basis in small value if you think gold is going to be appreciated in future. You can buy one gold ETF, and if that is 150 rupee, then understand as gold value goes up, your ETF value also goes up. Yesterday I was discussing about BEES, BEES. This is just similar to BEES. Again, they will take gold price, they'll divide by either 100 or 1000 to make it liquid so that even small investors can participate. So what many people do, this is an alternate investment opportunity like gold bond, sovereign gold bond. You can also invest here. But in gold bond, you should buy at least 1 gram. And if 1 gram is say 5,500 rupees, then you should have at least 5,500 to buy. And for that, you have to wait for a particular time period. But the advantage there is you also earn some interest. If you know, in sovereign gold bond, you get, I think, 2.5% annual interest. But here you are buying gold like a share. Gold ETF is a derivative instrument. Any derivative instrument, when I say, understand, it derives its value from an underlying asset. And what is the underlying asset here? Gold. If gold goes up, ETF price goes up. So today, just an example, if gold is 60,000 rupee, they will divide that by 1000 or by 100, and then they create one gold ETF. If it is 60 rupee, then understand, if you're buying one ETF, you're as good as buying 1 by 1000 grams. You're not buying 1 gram, you're buying 1 by 1000 grams. And this gold ETF and Nifty, both you follow on daily basis. Whenever Nifty is in green, your gold ETF will be in red, and vice versa. This is negatively correlated. Now, why is it in this direction all the time? Why is gold always in opposite direction? People who have invested in stock market, they believe they have taken more risk than investing in gold. So the moment they put money here, and if there is a problem in stock market, what majority of Indian population does, the mass following, everyone is selling, I will also sell. Nifty fell down, that means something is wrong. I don't know what is wrong. Because it is down, maybe something is wrong. This is what many people do, and they start selling. Once they sell, what happens? Money comes to their account. What to do with that money? Immediately they'll buy gold, because they feel gold is safer than investing in Nifty. And whenever Nifty goes up, they start getting sudden confidence in Indian economy. Then what they do? Gold they sell and shift money to Nifty. That's why these two will always go in opposite direction. It may not happen on same day, but if today Nifty is up, tomorrow at least gold ETF will be down, because people will wait till 3:30 and then sell. They may sell Nifty, but they may not buy gold that day itself. They may buy gold the next day. So at least the same day or T plus 1, the next day, you will always see an inverse movement in gold. So now you know during lockdown why gold prices went up, because all those who had huge amount of money in stock market, because it started going down by 15%, 20%, 30%, they started selling, panic selling. Once they start selling, what happens? You sell Infosys share, money comes to you. What to do with that money? You won't withdraw. If that was the case, you would have never entered stock market. You'll never put that money in bank FD. You decided not to do bank FD. That's why you are in Demat account. Now that money is in Demat, what you do? Buy gold in the form of ETF. And then when everyone wants to buy, demand for gold ETF will suddenly go up. If demand goes up, price go up. You know who are the smartest investors who added money in Demat account during lockdown? Majority did reverse. I'll give you 2 3 numbers. You can check about this after the class. Every share was available at 50% discount. Minimum 50% discount. Reliance was below 1000 rupees. Now I think it's around 2400, 2500. Before lockdown, now you shouldn't compare today's value with that value. Before lockdown, it was around 1800. Lockdown was announced and then Reliance went down by almost 50%. It went down to around 900, 800, 750 was, I think, the lowest number. Real long term investors who have patience, who understand the market properly, they added huge amount of money during lockdown, because you invest money during lockdown and wait for just 3 months or 6 months for the lockdown to be lifted and the virus problem to go, then all these shares will come back to their original number before lockdown. So you just see February and October. In between March, April was all the problem. And then by not even October, some shares recovered within 3 4 months itself. Lot of them doubled their money in 3 months. Gold prices went up like anything, because lot, when I say, it's only very few. It's not the mass. Mass just started selling stock market because they thought, if something happens to me, I don't want my money in stock market. I want hard cash. What if I get admitted to hospital? Where is the money? All this. And then they thought all companies will get closed because lockdown will be forever. Understand, today it is easy to say. That day everybody was thinking like this. You were also thinking like this. I was also thinking like this. Land prices went down, apartment prices went down. Everyone thought no one will ever come back to Bangalore. It'll all be work from home forever. Most of the apartments were available at 30 40% discount. Land site prices were available at almost 30 40% discount. You have never seen site at discount. But I remember that time people were scared to even go out and register that land in their name, because first time we did not know. Second wave, this did not happen because people had 9 months experience of handling COVID. No, if you check this gold ETF and Nifty during second wave, you won't see such reaction, because people had understood. And what happened during lockdown, many had free time and many wanted to invest in stock market, but they never had time to learn about it. Maximum number of Demat accounts opened in that financial year, 2021. Why? People were free. And when you are free, the only source of entertainment is mobile. And you wanted to make money because you have free time. Now you wanted to learn stock market. You never had time to learn stock market. Many joined stock market courses. Many learned what to do in stock market. Maximum SIP, maximum mutual fund, maximum Demat account in the history of India, 2020 to 2021 is the year. After that also it is increasing every month. SIP, if you see last month report also, we are having highest inflows only. So people realize something after 2020. People did not realize it up to that point. People had free time. So if you have free time, you had mobile and internet. That was the only source of time pass, source of entertainment, source of learning. Everything was in one place. Now stock market went down. Many people opened Demat accounts, started learning. And when you want to start, you always start with safest investment. People started with gold again. And then who were investing from many years also, because of this mass selling, They started selling every share, Tata Motors, Maruti Suzuki, State Bank of India, especially these transportation, hospitality, tourism sector shares were available at 70% discount, not even 50%. Small cap, mid cap, large cap, all variety. There is no theme, there is no sector, there is no capitalization segment also. All shares are available. If you are doubting Reliance Industries Limited, not one lockdown, mark my words, 5 lockdowns also nothing will happen to Reliance, because they're sitting with lakhs of crores of reserve, cash reserve, so they can survive any lockdown, any virus. And some of these guys had this thought also, what if I invest and lockdown is forever, or virus kills everyone? If it kills everyone, then even you will die. Why do you want to keep money in bank and die? You can keep in demat account and die. And if lockdown is going, virus is going, then good to keep money in stock market and wait for 6 months or 8 months or 1 year. I understand today it's all joke. That day it was not joke. Same sentence if I told you that day, everyone would have doubted. But maybe 3 months, maybe 6 months, maybe 1 year, maybe 5 years. But in 5 years also, your money would have gone up by times, not percent, times 3x, 5x, 8x. One thing that you should not do is this: mass selling and mass buying. Mass buying during IPO, mass selling during these kind of situations. One good example, those who are interested, make a note of this and follow this. There is a company called VRL Logistics, correct? You might have seen this yellow black color logo. Again, what happens when there is a lockdown? No one was allowed to travel. People started selling the share like crazy. It was around 300 plus, came down to 140, 150. 5 minutes if you spend and go to VRL website and download their last annual report and read the director report, you will get to know their 80% revenue is from goods transportation. 15 to 20% is from passenger transportation. And in that goods transportation also, majority was FMCG. And FMCG was allowed even during lockdown. Food was coming to my house, your house, vegetables, all the items were allowed. That means VRL was not supposed to be sold like crazy. People thought it's only bus for passengers and passengers won't move now. So this company, Indigo, another example, Indigo Airlines. Coming back to VRL, people thought this is going, company may get closed. Share was available at 130 at one point, 130, 140. Now people who invested huge money, which is very less number of people, but they invest in bulk. Those people who know all these things, they invest in bulk. Mutual fund companies, insurance companies, large investors, foreign investors, they invested huge money in these kind of shares and waited for 3 months, 6 months to recover, and then 170, 140, 150 all went back to old number, 320, 340. People doubled their money within 3 to 6 months. And what happened when Nifty was going down like this? Your gold price was shooting up like anything. That means there is a negative correlation between gold ETF and Nifty. So this is one thing that I want you to follow. Even if you do not have demat account, you can bookmark this on your Google Chrome and watch every day or once in a week at least to check what happened to gold ETF trend and what happened to Nifty trend. This correlation is written with the sign R. Remember, R can be -1 to +1. If R is equal to +1, then there is a strong correlation or positive correlation. I'll dictate, don't worry now, don't write. If it is -1, then there is complete reverse correlation. This was our Nifty and gold ETF example. What is an example for R is equal to +1? Demand and price. If demand goes up, price will also go up. Here, if Nifty goes up, your gold ETF goes down, correct? Then try and answer what is the meaning of R is equal to 0. There is no relationship at all, correct? If Nifty is in one direction, gold can be in any direction. If that is happening, then R is equal to 0. There is no relationship between these two items. Bank FD rate with Nifty. Nifty is up or down, bank FD won't even react. Forget reacting in this direction or that direction. Not even connected. Two completely independent items. will have R is equal to 0. But there is a possibility R can be in the range of 0 to 1. It is not only three possibilities: minus 1, 0, 1. It can be 0 to 1, and it can be minus 1 to 0. This is called strong correlation. This is called moderate correlation. Understand, strong correlation is if this goes up, this has to go up, no doubt. But when it is in the range 0 to 1, if one variable goes up, other variable may go up. There is a higher chance of that going up, but there is some chance it may go down also. I'll take an example. There is a project for 2 years. First year there is a profit. If there is positive one correlation, then second year also it has to be profit only. That is R is equal to plus 1. But if R is in the range 0 to 1, then first year if there is a profit, second year there is higher chance of profit, but there is some chance of loss also. There is 80% of profit, there is 20% of loss. That means this is in the range of 0 to 1.8. It is moderately correlated. It is not fully correlated. Understanding, therefore, that there can be 5 different numbers for R. R is equal to 0, no relationship at all. R is equal to positive 1, strong correlation, fully correlated. R is equal to minus 1, fully negative. R in the range 0 to positive 1, positively correlated but not fully. It is moderate correlation. And R is equal to 0 to minus 1. First year there is a profit. Next year there can be loss or there can be profit. There is 80% chance of loss, 20% chance of profit. That means there is 0 to minus 1, 0.8 negative is the correlation. If it is minus 1, then first year profit, second year it has to be loss only. Exact opposite will be minus 1. Can be opposite, need not be opposite also. It will be in the range 0 to minus 1. Clear? Right now in page 198, heading concept of correlation. Correlation is represented as small r. In bracket, it is also called as correlation coefficient. Correlation coefficient. Range for r is equal to minus 1 to plus 1, minus 1 plus 1. Start one by one. R is equal to plus 1. R is equal to plus 1 is equal to 2 numbers r. 2 numbers r positively correlated in bracket. This is also called as strong positive correlation. Some books even call it as perfect positive correlation. Perfect positive correlation. Second, R is equal to minus 1. What is this now? 2 numbers are negatively correlated. In bracket, strong negative. perfect negative. R is equal to 0. Two numbers are not at all correlated. Two numbers are not at all correlated. What does it mean? First year you have profit. Second year there can be anything. Can be profit, can be loss, can be break even, zero profit, zero loss. Second year profit is independent of first year profit. Understand the sentence. When I say independent, that means there is no correlation. If I say second year profit is dependent on first year profit, that means there is a correlation. If it is +1, then it is strong positive. If it is 0 to 1, then it is moderately positive. Correct? That's how we have to use it in our answer. Year 1 cash flow is positive. Whether year 2 will be positive or negative or can be anything, that depends on whether R is 1. 1 means +1, -1, or R is equal to 0. What is the next possibility? R is equal to 0 to +1. Then two numbers are moderately positively correlated. Moderately positively correlated. We will write the examples later. Understand first. Year 1 profit. Year 2 greater chance of profit, but there is still some chances of loss. That means it is more than 0, but it is not fully +1. If it is fully +1, first year profit, second year also should be profit. But if I can't say should be profit, that means I'm not +1. I'm little less than +1. It can be 0.8, 0.7, 0.6. That is why it is in the range 0 to +1. Last answer. You can write either -1 to 0 or 0 to -1. It is same. Two numbers are moderately negatively correlated. Moderately negatively correlated. For your reference, just make a note. This was my case A. I've written here, correct? Just mark this as A, B, C, D, E. Then you can write this as A, this is B, this is C, this is D and E. Listen, in portfolio management topic, they will give you Nifty number. Nifty is the weighted average index of top 50 companies in NSE, and Reliance share price. And then the sentence is something like this: correlation between Nifty and Reliance is 0.8. 0.8 means more than 0, less than +1. That means if Nifty goes up, Reliance will also go up, but may not be fully correlated. If it is fully correlated, then Nifty goes up by 2%, Reliance also will go up by exact 2%. So if the correlation R is given as 0.8, that means if that goes up by 2%, it will go up, but not exactly 2%. That's how you will use this in portfolio management. What if they say correlation between Nifty and Reliance is 0? What is the meaning? Reliance and Nifty are not moving in any common direction. It can be anything. I'm not saying it has to be this only. I'm saying it can be anything. Nifty is up, Reliance can also be up. Nifty is up, Reliance can be down. Nifty is up, Reliance can be there only. There is no relationship between these numbers at all. correct? So in portfolio, in security valuation, in equity share valuation, there is something called beta calculation. In all those places you need correlation. Don't see the number, see whether it is positive or negative. Also zero point 0.8, it can be minus 0.8 also. Yes, just write some examples. Demand goes up and selling price goes up. Then tell me, fully correlated, strong, positive, correct? Nifty goes up, gold ETF comes down. In simple words, you call it as inverse relationship, is -1, correct? Demand goes up, fixed cost may remain same, correct? That means R is equal to 0. These are not at all connected. Understand? Simple meaning of R is equal to 0. These are not connected. Sales 0, then also there is fixed cost. Sales go up, then also there is fixed cost. I'm giving discount, there is still fixed cost. I'm not able to sell enough numbers, then also there is fixed cost. These are not going in any particular direction. Yeah. Next, first year profit, second year high chance of profit and low chance of loss. Tell me now, R is equal to what? 0 to +1, correct? There is correlation, but it is not strong positive. It is positive, but not strong positive. Same way, one last. First year loss, sorry, first year profit. Second year high chance of loss. Low chance of profit. Now R is equal to -1 to 0. This is a statistical technique. A finance expert by name Hiller used correlation in capital budgeting for the first time. That's why in study material they have given the heading as Hiller's scenario analysis. So it is not, Hiller did not invent R. Understand? Statistics had R. That was used in finance for the first time in capital budgeting. That's why it's called Hiller's scenario analysis. Just make a note of that. I'm not expecting this to be MCQ, but you never know. Yeah. Hiller used correlation in capital budgeting. Hence it is called Hiller's scenario analysis. End of the discussion on correlation. We will have to come back to this page once again when we go to portfolio management, there you have to calculate something called beta, and beta is based on correlation between Nifty and Reliance. And that time we will come back here. Anyway, now that we know the basics, we can go back to the topic, come to scenario analysis. Now tell me, I'm estimating NPV for a project having 3 years life. And for all 3 years, I've predicted best case, worst case, and moderate case. If I'm taking best case in year 1 also, year 2 also, year 3 also, then there should be a strong positive correlation between year 1 and year 2. Right? But if I say year 1 best case, year 2 has to be worst case, that means R between year 1 and year 2 is -1, negative correlation. But if I say year 1 is profit, year 2 can be anything. I'm not even saying anything. I'm saying it can be anything. Best case, worst case, moderate, then R is equal to 0. That is used in scenario analysis. Read. This analysis brings in the probability of changes in key variables and allows us to use, underline, more than one variable at a time. Important difference between sensitivity and scenario is this. There you change only one variable at a time. Here it is more than one. This analysis begins with base case or most likely set of values for the input variable, and then go for worst case scenario. What is worst case? Low unit of sales, low price, high variable cost, high taxes, high discounting rate, and so on. Everything that can go wrong. And best case scenario, sometimes even the moderate scenario is considered. In moderate, you have a mix. Cost is going up, price is also going up. One benefit, one cost to you. In summary, sensitivity is about analyzing how sensitive the project is for, underline, one item at a time. Scenario analysis is about analyzing how sensitive the project is for more than one at a time. Question number 11. X Limited is considering a project. Initial outflow 14 lakh. Project life is 3 years. Possible cash inflows are given to you. All numbers are in thousands. Particulars year 1, 2, 3. Worst case, most likely scenario, and best case scenario. Discount rate is 9%. Determine NPV in each scenario. Now, when they say each scenario, they want 3 NPVs. That is NPV in worst case scenario. But understand, when I say worst case scenario, year 1 450, year 2 also I have to take 400, year 3 also I have to take 700. That means there is a strong positive correlation. Loss is equal to loss is equal to loss. Correct? If I say best case scenario, then year 1 650, year 2 should be 500, year 3 should also be 900. That means these are dependent variables. What is the meaning of dependent variable? Second year cash inflow depends on first year. Correct? Second year will be best case if first year is also best case. Dependent and independent. What is independent variable? Year 1 maybe 450, maybe 550, maybe 650. But year 2 has to be 450 only. That means year 1 and year 2 are not dependent. They are independent variables. There are two things: dependent, independent. How much will I earn tomorrow? That is fully dependent on how much I am earning today. That means these variables are dependent. Whatever happens today, tomorrow I am going to surely earn 25 rupee. That means these are independent variables. Understanding? In simple words, it is dependent, independent. In correlation term, it is in the range of -1 to +1. So now they have said each scenario, that means I will have 3 answers: NPV best case, start with NPV worst case, NPV most likely, and NPV best case. Start. There is another sub question, we'll discuss that later. ACB 11. NPV under best, first I'll go in the order. Worst case scenario is equal to year 0 outflow 14 lakh, since they have given inflows in thousands, I'll take even this as 1400, 3 zeros less. This is year 0, correct? Year 1, 450, but this is at the end of year 1. This should be multiplied with discounting factor for year 1. Discount rate is 9%. So 1 divided by 1 plus R. What's the number? First year DF 917 plus year 2 also. I have to be in worst case line only because I'm assuming that these are fully positively correlated. Point 842. Third year 700 into 772. You have the answer? Minus 110. We are working out worst case scenario, so you shouldn't worry if you get a negative answer. In worst case also you're expecting positive NPV, then don't call it worst case scenario. Correct, it has to be negative, or at least it should be lowest out of 3. Second NPV under moderate scenario or most likely scenario, minus 1400, 550 into 0.917, 450 and 800. Positive 100 or 101 positive approximately. Last combination, NPV under best case scenario. Here you take 650, 500, 900 into the factors. You have final answer 312 positive. Understand, when we are writing numbers like this, we are assuming that all cash flows have R is equal to positive 1. Otherwise, it can't be best in all 3. In exam, for MCQ, they can give 2 years data, best case and worst case only, year 1, year 2. And they may ask you to work out NPV by assuming that the cash flows are fully negatively correlated, then first year you have to take best case, second year you have to take worst case if it is negatively correlated. If they simply say correlation between year 1 and year 2 is positive 1, that means first year best case, second year also has to be best case only. They won't give question like this for MCQ, determine NPV in each scenario. Then you'll work out all three answers. They may give, I'll just draft a question, just follow this. Year 0, say 1 lakh rupee cash outflow. Year 1, best case 80,000, worst case 30,000. Year 2, best case, say 1 lakh, or I'll take 90,000, and this is 40,000. Assume discounting factor at 10%. What if they say calculate NPV assuming that R between year 1 and year 2 is equal to +1? Now what is the meaning of R between year 1 and 2 is +1? If this is 80,000, this has to be 90,000 because these are strong positively correlated, correct? If they say R is equal to -1, then if you take 80,000 for first year, you have to take 40,000 for second year, or it can be even this and this, correct? Understanding? Therefore, they can add one more here. R is equal to +1, and first year there is best case. Now tell me, first year if it is best case, then you have to start with 80,000, and if R is equal to +1, then even this has to be profit only. That means question is 80,000 year 1, 90,000 year 2. They won't mention all this. They will simply give one number. Based on this, you have to decide whether it is 90 to be taken in second year or 40 to be taken. Sir, what if they say R is equal to 0? Then first year, even if you have best case, second year there can be either 90 or 40. Then they may give option A like this. If you work out 80 and 90, the answer that you get, and 80 and 40, the answer you get. That and this can be your option A. Understanding? They have enough time to sit and draft all these questions. You can also start drafting these questions, right? When they say R is equal to 0, then any of the two can happen. So if you take 80 and 90, one answer, 80 and 40, another answer. Since they said first year is best case, then you have to start from 80 only. And they'll create such options where if you start with 30,000 also, you'll get some numbers. But since year 1 is best case, you have to start with 80. Whether year 2 will be 90 or 40 or 90/40, that depends on whether R is 1, -1 or R is equal to 0. In MCQ, they can easily do this. Correct? You see the next line in the question. They have already given similar adjustment. If company is expecting most likely result for first and second year, that means R is equal to +1 in year 1 and year 2. Both most likely, but they are uncertain about third year. What will be the NPV of the project expecting worst case in third year? Now tell me for your answer, which are the three numbers to be taken? 550, 450 and 700. Instead, they can change one wording. They may say, what will be the conservative estimate of NPV, and they don't mention this. Now tell me, to call it as conservative estimate, when you are not sure, you have to take the lowest. Year 1 and year 2, you are sure you will earn 550, 450. Year 3, you are not sure. And then they use the word conservative, then you have to take the lowest of the three. If they say aggressive, then you take the highest. Or if they say year 3 and year 2, R is equal to +1, then you have to take 800, because +1 is fully correlated. If year 2 is 450, year 3 should also be 800. It should be most likely only. This is how they can club correlation with scenario analysis. They may not print everything, year 1, year 2, year 3, this will happen. They may just say year 1 and then they say R is equal to +1. Correct? One more possibility. What if they give year 1, year 2, year 3, same question, worst case, most likely and best, and then they say year 1 we are expecting best case scenario, and R between year 1 and year 2 is -1, and R between year 2 and year 3 is +1. Go slow now. First year you are starting with best case, then year 1 and year 2 is -1, that means you have to take the worst case, and year 2 to year 3 plus 1, that means you should stay here only. It is minus of minus, correct? Now don't come down here. I hope you're understanding. Yeah, year 1 and year 2 is minus 1. If this is best, this has to be worst. Now year 2 to year 3 is positive. That means if this is worst, even this will be worst only. That means your answer will have this number, and this number. This they can do in MCQ. Question will be slightly bigger actually. Year 1, 2, 3, R, etc. Answer is actually very small and quick. Understanding? What if they say R between year 1, 2, 3 is equal to minus 1? Then best case is the starting point. Then minus 1 will take you here. From here, minus 1 will take you here. It won't stay there. I hope you're understanding this. If not, this portion that I'm discussing, you try once again today. What is the meaning of R minus 1, R 0 and R plus 1? What if they say first year is worst case scenario? I'm just changing. We'll learn different combinations. What if they say first year is worst case scenario and R between year 1 and 2 is plus 1? What is the meaning of plus 1? Strong positive. That means if this is worst, even this has to be worst. And what if year 2 and year 3 is minus 1? If this is worst, then this has to be best. Then year 3 will have to take the best case scenario number. What if they say 1, 2 and 3 is positive 1? Then you stay in the same line, worst, worst, worst. And this is what you did just now. Without they mentioning R is equal to plus 1, you took same best, best, best and worst, worst and worst. Can happen in MCQ pattern. Clear? Start now. Revised NPV is equal to, what are they saying? First outflow, no change. Read that paragraph. Most likely result for first and second. That means I should take 550, 450. This is a discounting factor first year. This is a discounting factor second year. And third, they're talking about what? Worst case, 700 into DF3. Is that correct? Done. Now all this is correct if R is equal to plus 1 or minus 1. But most of the cases it is neither plus 1 nor minus 1. It is in the range. Correct? 0.8, 0.4. There is a higher chance. Understand my sentence. If first year is best case, second year there is a greater chance of best case, but there is still some chances of moderate, some chances of worst case also. That's why I don't want you to copy this. We will discuss this some other day. Remember this. When was the last time you saw this? Again, most hated rank 2 item. What was this called, by the way? Distribution, normal distribution. Anyone? By now, those are from foundation at least should know all of this. This was there in foundation also. Binomial distribution, normal distribution. If this is 0, then this is plus 1, this is minus 1. If you remember, most of the items were in this range. Correct? These are always extremes. What is the meaning of extreme? Plus 1. Whenever one number goes up, the other number also has to go up. In real world, the chances are less. In real world, the chances are, the probability is more than 0. That means there is positive correlation. Strong positive correlation is not going to happen every time. First year I am in best case scenario. I can't say second year also I will be in best case only. Maximum what I can say 80% best case chances in year 2. 10% moderate, 10% there is still worst case possibility. That means most of the times the answer is between 0 to 1, and that is learnt in next concept called decision tree analysis. Scenario analysis works out if it is best, best and best. That means you're talking about R is equal to +1. But in reality, most of the times things are here, correct? Above 0, below 1. You will understand with that question number 12 what is the slight difference between scenario and decision tree. Read. This is another method. J Limited is planning to invest 80,000 in a project having 2 years life. Below cash inflows are given to you. Understand this table properly. Year 1, there is 40% chance, 0.4 probability, 40% chance of earning 50,000, 60% chance of earning 60,000. Year 2, you observe, if I earn 50,000 in first year, then my second year will be either 24 or 32 or 44. Correct? But first year itself, if I'm earning 60,000, then my second year will be either 40 or 50 or 60. That means second year cash flow is dependent on first year cash flow. You cannot earn 50,000 in first year and expect 60,000 in second year. Understanding? If you want 60,000 in second year, there is 10% chance, and that too after earning 60,000 in first year. That itself there is 60% chance. Able to follow? These kind of problems cannot be worked out using scenario analysis, because now tell me there are 6 scenarios. Am I correct? Think and tell me. Why did I say 6 scenarios? You may earn 50 and 24. You may earn 50 and 32. You may earn 50 and 44. Second set 60 40, 60 50, 60 60. Second year numbers are dependent on first year number. For this, we need decision tree analysis. Consider 10%, draw a tree, and advise whether the project should be accepted or not. Don't imagine a tree to be actually drawn. It won't be like a tree, but then if I move the screen, then it will look like a tree. Okay, listen first. Don't copy. It requires a lot of space. Year 0, year 1 and year 2, and then this is called path or direction. Year 0, what's the investment? 80,000, correct? Year 1, what can happen? 2 chances. 1, you may earn 50,000. I'm sorry, I'll write it here. You may earn 50,000. You may earn 60,000. But chances of earning 50,000 is 0.4, and this is 0.6. It is positive because year 1 is inflow. If you earn 50 in first year, then there can be either 24,000 or 32,000 or 44,000, and this probability is 0.2, 0.3 and 0.5. This will be called as path A. What is the meaning of path A? I spend 80,000 in year 0, I earn 50,000 in first year, and I earn 24,000 in second year. If this becomes a reality, how much will be my NPV? But like this, you will have 6 paths now. Correct? Even this has 3 possibilities. Then you will have to work out the NPV for all possibilities. This is called path, or some books along with path they even write joint probability. Now tell me, what is the meaning of joint probability? When will this path A is going to happen in reality? If you earn 50,000 in first year and 24,000 in second year. And for that to happen, there is 40% chance in first year and 20% chance after that in second year. That means you should do 0.4 into 0.2. Joint probability is 0.08. Understand? I'm repeating. For path A to become reality, you should earn 80,000. There is no question, correct? Therefore, I'm not starting from year 0 every time. 80 has to go. That is right now, no doubt in that. But for path A to become reality, you should earn 50,000 in first year and 24,000 in second year. What is the chance of you earning 50,000 in first year? 40%. And if that happens, then what is the chance of earning 24,000? 20%. That means it is 0.4 into 0.2. That will be 0.08, which means there is 8% chance that you will have path A. Able to understand? Like this, I will have 6 numbers, and these are called joint probabilities. Can you start copying now? Start heading decision tree. Start with year 0. $80,000. Year 1. Can be either 50,000 or 60,000. Probability of that is 0.4 and 0.6. If you earn 50,000, then there are 3 possible outcomes in year 2. That is 24,000, 32,000 and 44,000. Last column in your table will be path and joint probability. For path A, joint probability will be 0.4 into 0.2. 0.4 into 0.2 is 0.08. Second is 0.4 into 0.3. 0.2. If you earn 60,000 in first year, then it can be 40, 50, 60,000. That probability is 0.4, 0.5, 0.1. Therefore, this is now 0.24, 0.30, 0.06. And as we discussed yesterday, total of probabilities should be equal to 1. That means at the end of 2 years, once my project is over, one of these 6 may happen. Now, this is not the main answer. This is a working note. This is decision tree. Now, if I have to show you the tree, I have to rotate the screen this way. And then this is your root. And then there are branches. That's the way you need to visualize. That's the only explanation I have. Otherwise, it's not looking like a tree. 80,000 is year 0. That is your investment. And then there can be multiple probable outcomes. Now, out of these 6 probabilities, which one is going to happen, we do not know. So we have to work out NPV under all possible cases. Now the main answer, computation of NPV. Make 4 columns. First one is smaller path. Next, slightly bigger column, NPV. Then joint probability. Last column, NPV into probability. I will show one path. First understand slowly, then you can copy. First path is A. Go to decision tree. If path A becomes the reality, then my NPV will be equal to minus 80,000, correct? 50,000 you will earn at the end of year 1. That will be multiplied by, what's the discount rate? 10%. So 0.909. And second year you should earn 24,000, and this will be 0.826. This will be the NPV if path A becomes a reality, correct? And what is the probability that path A will become reality? 0.08. This, when you multiply, you get NPV into joint probability. This is the way to fill this table. And once we do this for all 6, we have to get the grand total. If that is positive, then you go ahead with the project. Able to understand? Because one of the 6 only will happen, not all 6. Yes, start now. Path A. Go to tree, then you will get to know what to write. For path A to happen, it should be minus 80,000. That is year 0. So discounting factor you don't need. Plus 50,000 in year 1. But since it is year 1, I need to multiply with discount factor 0.909. Then second year I will earn 24,000. That is multiplied by second year discounting factor. Anyone has NPV number only, not last column. 14700 approximately. So you have exact number, anyone? 26, correct? This will be my NPV if path A becomes a reality. But what is the chance that path A will become a reality? Only 8%. That is your joint probability, 0.08. Yes, this should be minus, I think. Because these are small numbers, right? 50, 20. Without discounting itself, I mean minus. Therefore, this into 0.08. Anyone? 1178 I can take. Next, for path B, 80,000 negative, 50,000 into 0.909, and this should be now 32,000 into 0.826. Can somebody confirm? Negative 8118. And for path B, joint probability 0.12 974. Guys, initial numbers will be negative because in path A, B, and C, observe you are taking lowest number in year 1 and lowest number in year 2. When you are combining lowest of year 1 with lowest of year 2, you won't get a big NPV. Big NPV will come later when you take highest of year 1 and highest of year 2. Path C, same minus 80, same 50,000 positive, but year 2, last number is 44,000 into 0.826. Anybody? Positive? 84 is it? 94. And this is 0.2. 359 or 360 positive. Now path D, when you are working out, minus 80,000, this will be now 60,000, correct, into 0.909, and this will be 40,000, 0.826. You have the number? Positive. And this was 0.24. 1819. 1 second, stop writing. In exam, if they don't ask you to draw decision tree and simply ask you to work out NPV, do you think we need the decision tree, then only we can do this table, or can we do it without tree? Joint probability, sir, from where do I get that? You can multiply 0.4 into 0.2, 0.4 into 0.3. That means tree is not mandatory. If I am writing, because in the question they mentioned draw a tree and then advice. If the question is simply advice, then I'll write the heading based on decision tree. I won't draw the tree. I can directly come to the table. Correct? The tree is only to understand the concept and to find out joint probability. That I can do without tree also. You know what they should do in MCQ? Tree they should print in the question and ask you to find out only the NPV. Then only this part you will have to do. That's what is going to happen, as I told you on day 1 also. Same question, half answer they can print. The other half they will ask you to work out in MCQ. Continue. This is path E. Minus 80,000, 60,000 into 0.909. This has to be now 50,000 into 0.826. What's the number? And this is 0.3. You can try the last one and tell me the numbers. 0.06. This summation positive, that's important. Number is not, because one of the 6 is going to happen. You're only trying to see whether there is a greater chance of positive result or not. Said what? 6,000, 6224 positive. This is what happens when R is 0 to 1. If you see R is not 1, if R is 1, then year 2 cash flow should be only one number. If you earn 50,000 in first year, you will earn 24,000 only. Then R is strong positive. But they say if you earn 50,000, then you may earn 24, you may earn 32, you may earn 44. That means R is more than 0 but less than 1. There is a positive correlation, but it's not a strong positive correlation. Now they've asked you to advise, so one line conclusion. Since probable NPV is positive, since probable NPV is positive, comma, project should be accepted. Project should be accepted. Listen, one more thing that can be done in exam. Tell me this total probability should be equal to 1. Correct? And year 2 this total should be equal to 1. This total also should be equal to 1. Correct? They may not print one of these numbers. They may simply say P is equal to question mark. Now for year 2, 3 outcomes, the total of probability should be equal to 1. If I have first and second number, this P has to be balancing figure. They may not print this also. Or first line itself, they may say in year 1 there is 40% probability of earning 50,000. There is also a chance of earning 60,000 without mentioning. If this is P, then this should be 1 minus P. Correct? Because total of the two should be equal to 1. If this probability is 40%, then this probability should be 60%. It is like saying chances of head is 0.5. Then you should understand that chances of tail when you toss a coin should be 1 minus P, which is 1 minus 0.5, that is equal to 0.5. Understanding? So they may not give you neat question also. In that also there can be a missing figure. Yes. If they really want to test your stats knowledge, they should print decision tree and NPV calculation also, and should not print probability figures. Then you should do reverse working. Let this be X, and then this has to be 1 minus X. Correct? And then in your main table, it will be minus 80,000. Understand? Minus 80,000 plus 50,000 into DF1 plus 60,000 into DF2. This number, whereas joint probability you don't know. Joint probability will be what now? X, and then this number. Then from there you may have to do. But the fun with MCQ, you don't have to do any reverse working. You put the number and see whichever matches you tick and come. I don't want to start teaching this way. You should know the reverse working. But in case if you find that it's a reverse working sum and I don't have reverse working always takes time. You have to assume it as X. What if one more number is unknown? Then X, Y, then simultaneous equation, all of that. The last option is put the numbers and see where it matches. So my guess is they will not give any question where you can substitute and tick. They know what you know already. And one more thing, in all practical papers, if it is MCQ and if you want to tick none of the above, be very, very careful. Understand why I am saying. If it's a practical sum, say this question itself is a 1 mark MCQ. Yeah. And then answer is 6224, option A, positive, option B 8,000, option C say positive 2,150, option D if they print none of the above. Okay. Now those students who don't know decision tree and do all mistakes, if someone gets correct answer according to that student minus 768, he will also take none of the above. He doesn't know decision tree. He did something, some half decision tree, he remembered, he tried something. Another student got positive 7,150. Even he will take none of them. Both are wrong, but both will get marks. Understand? Okay, I'll make it easy for you. Suppose this option is printed as 350. Now tell me which is the correct answer. None of the above. You know the subject, you worked out full sum, you got 6224, you will take none of the above, you deserve mark. Another guy did complete wrong decision tree. He got positive 768. He will also take none of the above. Someone got minus 10,850. He will also take none of the above. Only that one student who got 6224, he should get marks. Other three should not get marks. But what to do? That is the correct answer. Therefore, this will never happen. They will never give a practical question where none. What if somebody gets 0? Even he will take none of the above. Correct? Therefore, all 4 students will get marks. Only one guy is correct. Other 3 wrong also. They have take correct option. None of the above. This possibility is very, very less. In theory, if you want to take all of the above, none of the above, there is a case. There are lot of theory MCQs which can be none of the above, all of the above. Practical questions, even if you think you are correct, if you are ticking none of the above, please recheck your answer, then only tick, because someone sitting next to you got some total random wrong answer. Even he will take none of the above. Therefore, such possibilities are very, very less. Understanding? Yes, with this we are done for today. Tomorrow we will continue with simulation. If you don't want to answer in class, you can answer this question later. Anyone here actively participates in gambling? Anyone? How many of you have played at least once casino game? Casino is gambling only. Okay, not an active casino player. Monte Carlo simulation, the next method, was invented only to win casino. Monte Carlo is a name of the place where casino was popular. Therefore, that method name itself is Monte Carlo is not the person who invented simulation. That's the name of the place where casino was popular. To win casino game, they wanted to have a statistical model. That's when they created something called simulation, okay, which we will study, and that is used in capital budgeting, because doing a project is also a kind of gambling. You have to start with that understanding and then work out the sum. We will learn this tomorrow. Thank you so much.